So we are talking interest rates again. It's the theme of the year. The Fed is expected to raise rates this afternoon by another 75 basis points. There's a small chance that they'll do less at 0.5%, and there's about a 20% chance that they'll do 1%. Realistically, what's happening though is what I want to talk about is why is the stock market dropping when the Fed raises interest rates? It does create fear when the Fed raises rates, and certainly it creates trouble in the mortgage markets and in places where people are borrowing money because it's more expensive to borrow. But really it boils down to a couple things with the stock market. Number one, when the Fed is raising rates, the risk of recession gets higher every time. And in a recession, stock and corporate earnings tend to be down, which equals a decline in the stock price. And investors are in the business of trying to predict that response. And so often in the prediction mode, when recession is expected, there's more sellers of a company than buyers, and the price tends to decline because of the expectation that that company's earnings will not be as strong in a recession. Now, that's not every company though, and so it is diversification is important for that reason, because some companies do pretty well in recessions. And so that's again why you diversify. But that's one reason stock prices tend to decline as the Fed discusses and raises rates. The other reason is short-term opportunity. So a short-term investor is in the business of trying to predict the best place for their money over, say, a 6-month or 1-year period. The time period is arbitrary in terms of it's just a short-term period. And so when they're looking at the risk of recession and the Fed raising rates, a short-term investor asks themselves, is my money over the next 6 months or a year better in the stock market or better in bonds or cash or some other alternative to the stock market? And when the Fed's raising rates, oftentimes the answer is it's better off in cash, fixed income, while the risk of recession is so high. And so again, that creates a situation where you have more sellers than buyers in the market, and the general stock market valuation tends to go down. And so that's what we're seeing right now, is a lot of this, well, short term over the next 6 months or so, we think that the stock market might stay down, or it might not be as much opportunity, and so we're sticking with cash or some other alternative. Even though the inflation rate's 8%, we're willing to accept that. And that's again why we don't try to be short-term investors, because it's very difficult to predict and you can often get that wrong. And so we want to stay focused on the long term. We want to use the bucket approach, our income and stages approach, to solve that problem by eliminating the need to predict stock market outcomes over a short period of time, and just again stay focused on long-term potential outcomes, which have generally been good in the market, and certainly there's no reason to believe at this point that that has changed. So it's a little bit of a discussion on stock market volatility and interest rates and why it happens. Again, I would expect the Fed to raise those rates 75 basis points today. Hopefully the market is not going to be surprised by that, and they've already priced that in. That will be remain to be seen for the next week or so as to what the reaction is. Hope everybody's having a good week. We'll talk to you soon.